Thursday's mini rout caused by investors who freaked out over the pandemic fears due to the soaring number of Delta cases and fears of slower growth was over by Friday as stocks rose to record levels. The S&P 500 added more than 1% with financials, materials, and energy sectors leading the way. These were the same sectors that were some of Thursday's biggest losers. The Dow and the Nasdaq also set fresh record closing highs by the end of the session. One of the reasons for the surge in stocks was the rebound in the 10-year yields, which, after crumbling earlier in the week, moved back up over 1.3%. And the move in stocks was also helped by China's dovish capitulation, with Beijing announcing early on Friday morning that the PBOC would cut rates and inject 1 trillion yuan into the system. So maybe some of this money will flow into Alibaba. Well, one can hope. As for me, I had the week off once again since I continued to struggle with my recording and editing programs. Now, these programs are free, as are the charts that I show you. I want to do everything free so that you can repeat everything that I do. But if you do follow me, you should have had no concerns, as the charts will always keep your emotions in check. And with that, let's see what they say. And today we're going to take a quick look at two charts, beginning here with the 20-year monthly chart on the Spiders S&P 500, the SPY, and the close on Friday was 435.52. Now, we've talked about the bottom and the huge move all the way up, but let's take a closer look at the top. Now, moving here into volume, not going to tell us much, it looks fine. Now here, in the MAC, you can see that there's a very wide separation between the fast line there and the slow line here. We're at nosebleed levels here at 34.69 on the fast line and 26.86 on the slow line. This is elevated to heights we haven't ever seen. So, a couple of things to mention. First of all, that wide separation means that almost anything can happen. Even if we do start to trend down on the fast line, I think the market can move sideways unless there's something that is triggering a fast move down. And I don't think that's in the cards, at least not yet. But looking here at the histogram, you can see that just barely we may have a topping process beginning here. And that really isn't a concern, at least at this point. And I'll show you in the next chart what I mean. But here into the price rate of change, same thing. This spike way on up here at that point is heading on down. So it's showing some cautionary flags. So we need to pay attention. Here in the RSI, we're still at 83.11, which is finally into that overbought territory, but it's not really significant, such as we were back in 2017 into early 2018. And we've been up there a number of times, as you can see, going back here and back here. But such as 2007, maybe we should pay attention. Maybe there are some cautionary flags that we need to be prudent and patient. Into stochastics, it looks like we're just rounding up the top here. But as you can see in other time frames, we can trundle along for a good period of time without any problems. Sometimes it's a quick move down, but other times back here it's years before we roll over. So not too concerned about that as of yet. And the same thing goes for the Williams. Back up there in that overbought territory, we're at a very high negative 0.28. So that's pretty slim. But I think we're going to continue to roll on. Moving back on up here to the price chart, one last look, and let's go now and take a look at the Russell 2000. And now we're taking a look at the iShares Russell 2000 ETF, and the symbol is IWM, and this serves as a pretty good proxy for the Russell 2000. So looking at this chart, a nice bounce off of the 200 EMA, and then we rocketed on up. So what I wanted to show you is that we can remain up here for a number of months. The Russell 2000 is well ahead of the S&P in its evolution, and it too is also showing a topping process, but as you can see, it's been up here for a number of months. So that topping process is there. Now, we are here in the 20 EMA, and there's a pretty good separation between that and the price chart. Same thing for the S&P. So we're at levels that we haven't seen going all the way back. And when you can see some extensions in the price chart above, say the 20 or the 50 EMA, that's a time to be very cautious. So this is definitely a time to be cautious. But at the same time, I'm saying that we can remain up here for a while. So just be cautious. Here into volume, that's not showing us too much. But here into the MAC, pretty much the same thing as the S&P. Big separation between the fast line and the slow line. And that means that anything can happen. And here into the MAC, you can see that this has receded for, let's see, 1, 2, 3 months, as opposed to the S&P, which is only at 1 month, and we're just at the beginning of that month. So even when, say, the histogram starts to recede and some of these other oscillators are indicating some downtrends, such as here with the price rate of change, that doesn't necessarily mean that we're going to have a crash or a huge pullback. But it is a time to be cautious with what your portfolio is and what your buying is as well. We're up here into this territory on the RSI. We've moved down and go back here in 2018. We are at that point, and that just preceded a pretty good downtrend in the market there. In 2014, late 2013, the same thing. This kind of preceded the downtrend in 2015, 2016. And here in 2011, and of course there in 2007. So a number of markers that indicate to us that we need to start paying real close attention to this. And then the stochastics, pretty much like the S&P, and the Williams, also like the S&P. We can hang up there for a long period of time without any trouble. One last look at the price chart, and there we are, possible topping process. So let's just put a little more pressure on the brake and show some caution, as well as prudence and patience. And for today, that's ChewDog Charts. Thank you.